Hi and welcome to this video. Let me start first off with my sincere apologies. I had promised that I was going to have this video out 8 p.m. yesterday, but as I was drawing up my slides, it took a bit longer than usual, and unfortunately, due to the algorithm, had I posted it a few hours after that, it wouldn't have done so well. Apparently, from my end, what I see is that videos tend to do well more like evening in 6, 7, maybe tops 8. You can have videos do well early in the morning. So this video should be out about 6 a.m. ish Nigerian time. A few of my usual bells and whistles are missing, but they should be back in the next video. So, Academy Press is a company in the publishing space. They are essentially largely a book firm, but they do a bit of commercial printing here and there. And yesterday they released their audited full year 2025 numbers. They run a rather odd financial year whereby the financial year ends in March. And luckily, the other two players in that space, Learn Africa and University Press, also run a similar financial year. So it makes it easy to compare all of them. Um, so let's look at the numbers. I have a few numbers below that you can't see. So at some point in time, I would squeeze my screen. Starting with income, I mean, revenue was essentially flat. Cost of sales went down much better. Then you had the gross profit up. Profit before tax up 343%. Profit after tax a whooping 873.3%. Profit margins aren't bad. Company had profit margin of 15.6 percent. My cutoff for profit margins ideally is 20, but I can kind of manage 15%. But typically, in my view, this stock is a stock I'd rather go for as a dividend play. And even when I compare it to other players in that space, I think Len has probably the most decent earnings when you strip away other income. And I'd have an article up sometime today as you another 3 4 hours time. So if you follow my Substack or follow me on Twitter, you'd see the article there. Please do so because we are in earnings season. There's going to be a chunk of companies that will drop their earnings. Not all of them would have a video. Some I might do a Spotify podcast episode. Some I might just post on Twitter or post across my social media platforms, put a screenshot. So these numbers, I mean, the margins are okay. The firm has proposed a dividend of 15 kobo. Payout ratio is small, but when you strip away, I did that with my own numbers, and I would show somewhere alongside the other firms. Yes, you have an earnings per share of 95 kobo. Not bad. The stock is trading at around 7.3 times earnings. It gained 10% yesterday. So P ratio went up a bit. But when you look at it, if you strip away other income, the P ratio drops to, the earnings per share drops to about 45, 47 kobo. So in actual fact, in my view, if you're going to value these firms, first thing you need to do is strip away their other income. Strip it away totally from profit after tax or profit before tax, and then work out your numbers. So in reality, the stock is trading at what? Maybe 50 kobo in earnings per share. 50 multiplied by 15 is trading about 15 times earnings. For a firm that's maybe growing, ideally, if you strip away all the one-off losses the last couple of years, it's probably growing its earnings per share at maybe 10, 15%. So it shouldn't be, you can't value it at that high multiple. That is the multiple you should use. It's growing 10, 15%. At tops, I think this stock should be maybe a 5 naira stock. So the results weren't too bad. revenue up 1%, profits up largely. I mean, remove the other income in dips, but most people don't look at that. But you should. That's the essence of this video. Dividend wise, the dividend yield is a bit poor, and I would squeeze down so you can see what I mean. Earnings yield 13.60, but the dividend yield is 2.1%. Now, in case you're wondering how dividend yield is calculated, you have your dividend divided by the price, current price or price per share. And so if you do that, you have a dividend yield of 2.1%, which is really poor. So this is not a dividend stock, except you get in at a decent price. So let's look at the breakdown of revenue. Luckily, most of this revenue is from books. I had initially planned to have a side by side comparing last year and this year, and I probably will do that in the written post, which I will share. But as I created the table would have been too big to present on my current screen. I'm using a fairly small screen. With time, I probably would start to use my laptop. The only challenge is I have all sorts of pop-ups on my laptop. And once you start screen recording on a laptop with all the pop-ups, yeah, it's not so good. But I should do that so that I can show some more color. So revenue-wise, I mean, the bulk of revenue is from books. Profit-wise, and if you notice, in fact, I actually couldn't believe I had to recalculate the numbers. I don't know how they were able to do it, but you can see that the gross profit margins across all segments are what 30%, which is interesting. So it seems that management has a deliberate policy to at least make 30% gross margins across all segments. So that's an admirable thing. Now let's look at the views, my recommendations, and as always, please note that this is not trading or investment advice. Current price closed yesterday at 770 kobo, up 10%. I guess markets were enthusiastic. In my view, this stock is a hold. It's a hold because these are numbers for last financial year. I'd like to see how the first quarter numbers are, maybe the second quarter. But if I were to pick, I wouldn't pick this. I think this is the Learn Africa, probably of the trio, has the best organic numbers. So if on the other hand you're able to get into this stock at a severe market downturn of maybe 4 naira or 5 naira, yeah, then maybe it might start to look good, because then your dividend yield should be what? 15 kobo divided by 5. What does that give? Which this is the downside of not using Excel. You can just simply type on this. So that gives you a dividend yield of 3%. I mean, that's still small, because you're in a market where you're earning what? You're earning 15, 17, 18% on money market funds, treasury bills, and the like. So if I'm going to hold an investment for cash, it needs to deliver those kind of returns. So I mean, this is a sector broadly, growth usually is 10, 15%. I don't know. So let's see how first quarter turns out to be. The first quarter actually makes sense. But for me, as I've stated all through this video, at best I'm neutral on the stock till I see that dip in price, or till I see better numbers of with organic earnings. These numbers were boosted by other revenue. The company had sold off some property, plants, and equipment. So if you strip those out, then you'd have a decline. And I will do that. So watch out on my other platforms where I'd show those numbers, put the trio together, and one can then see how they do. They're pretty interesting numbers. Have yourselves a good trading day ahead. Watch out for the next video. That should be up about 4.5 hours or 5 hours, depending on what time you're watching this from now, where I'll be looking at pre-market numbers and my reasons for doing so. So have a good day ahead. Any questions, comments, let me know, and see you soon.